Welcome to Essential Biz Marketing. Let's begin with Bibigo's global journey. This practice introduces how CheilJedang expanded Bibigo across markets, adapting entry modes to economic and cultural conditions. Here's the big picture. CheilJedang's global expansion shows how firms adjust entry modes to specific market traits. Bibigo moved from exports to acquisitions in the US as its commitment grew. Let's connect theory and practice. This analysis draws on Chapter 13's entry mode theories and Practice 2-1, 3, and 4. It highlights how market conditions shaped Bibigo's strategies. Now, the causal links. Bibigo's entry choices were determined by cultural, economic, and regulatory factors, not just correlations. Each market illustrates how theory guided strategy. Let's start with the US market. Bibigo entered the United States through exporting, a low-risk way to test demand. High income levels and advanced logistics made this approach possible. Market factors shaped the entry. The U.S. combines the world's highest per capita income, advanced logistics, and the largest retail market. These conditions made exporting efficient. Consumer fit was crucial. American consumers prefer convenience, individual meals, and premium options. Bibigo dumplings matched these tastes and gained strong traction. Commitment grew over time. As brand strength and demand increased, Bibigo shifted from exporting to local subsidiaries, gaining full control over branding, quality, and distribution. Now, let's turn to China. Bibigo avoided exporting and instead chose joint ventures with local production. This approach reflected China's unique market conditions. Two barriers shape this choice. China has low food import dependency, around 10%, which forces foreign firms to localize. Dumplings also carry deep cultural value as a shared family food. Joint ventures offered key advantages. Local production enabled cost efficiency, cultural credibility, and regulatory compliance. This strategy built trust and allowed Bibigo to compete with strong domestic players. Next, we move to Japan. The Japanese market shows high uncertainty avoidance, strong brand loyalty, and high labor costs. These factors made direct investment risky for Bibigo. Trust was the main barrier. Foreign brands face skepticism in Japan, especially in frozen foods where domestic giants dominate. Winning consumer trust was essential for entry. So Bibigo chose a cautious path. The company used OEM partnerships and retail collaborations. This low-investment strategy allowed quiet entry, shelf space access, and gradual brand building. Now let's look at the European Union. The EU offers a stable production environment but also high costs. This created both opportunities and constraints for Bibigo's expansion. Hungary stood out as a choice. Lower corporate taxes at 9%, labor flexibility, and attractive incentives made Hungary more competitive than Western EU countries. Location was another advantage. Hungary provided strong regional logistics and lower labor costs compared to the Western average, making it an efficient production hub. Bibigo committed fully here. The company established a wholly owned subsidiary in Hungary, gaining full control. The decision was driven by cost minimization and operational flexibility. This strategy had clear logic. By choosing Hungary, Bibigo balanced stability with efficiency, securing both market access and long-term competitiveness in Europe. Finally, let's examine Southeast Asia. Markets such as Vietnam and Indonesia offered entry opportunities, but low income levels and weak infrastructure made investment risky. Culture opened the door. Low uncertainty avoidance and high collectivism supported openness to bold foreign flavors and shared meals, creating room for Bibigo's products. Exports kept costs low. Bibigo chose exporting with local retail partners. This allowed affordable access while adapting to cultural acceptance. The logic was straightforward. Weak infrastructure combined with strong cultural fit made exporting the optimal mode for reaching Southeast Asian consumers. Let's wrap up with the overall logic. In the U.S., strong demand and brand power led Bibigo to shift from exports to ownership-based entry. China followed a different path. Deep cultural embeddedness and low import openness required local joint ventures. This ensured credibility and competitiveness. Japan demanded caution. High costs and brand skepticism made contractual partnerships the safer entry mode. OEM deals allowed gradual acceptance. Hungary offered unique advantages. Low taxes, flexible labor, and logistics strength drove Bibigo to establish a wholly owned subsidiary in the EU. Southeast Asia balanced risk and fit. Low income and underdeveloped infrastructure favored exporting, yet cultural openness allowed strong local reception. Here's the key insight. Bibigo's entry modes were strategically matched to local conditions, linking theory with practice across economic, cultural, and institutional factors. This concludes our session. Thank you for joining today's case study on Bibigo's global entry strategies. We look forward to exploring more insights together.